Assalamu alaikum friends. So finally the waiting is over. Your much awaited questions have come. Question on ethics. Okay. So we are finally over with group questions for 1 to 16. Now 17 onwards is questions on reporting and ethical implications. This question also comes in section A, 25 marks question, and in your ethics questions you will be getting 2 professional marks. And if you have seen that this paper is the latest paper, it is the September December 2019 paper. Okay, very recent paper. So let us just go through it. You can see that we have certain issues will be there which will be in different paragraphs. For question number 2 in your section A, you have cash advance from this, then you have preference shares. For that 4 marks for each, the marks are different. If you see, for the cash advance is 4 marks, preference share 4 marks, deferred tax asset is 3 marks. So the requirement is, there are 2 requirements. A is definitely mostly part A, or the first requirement is for other reporting issues. That means you need to use more than one standard on how it will be reported or measured or recognized and all those things. Part B is mostly the ethical questions. Okay, you might have more than 2 parts also. But the last question is always on ethics. That's what you need to know. So part A, discuss appropriate accounting treatments. This question is on accounting treatments. Which stent company should adopt for all issues identified above and the impact upon gearing? Okay. One is accounting treatment, the other one is impact upon gearing. For all the 3 you have to tell this. The marks are already given to you against each. Okay. For part B, for ethical, you already need these 4 lines to answer your ethic question. Discuss the ethical issues arising from the scenario, including any actions. You should also include any actions which the accountant should take to resolve issues. It's not important to give ethical issues. How to resolve those issues also you have to give. 7 marks is for writing, 2 marks is professional marks. How do you apply the ethical principles into this question? For that we will get the 2 professional marks. We'll show you how to get the 2 professional marks. Okay. Now it's your wish that you can either answer part A or part B. Okay. But I always follow the order, so I will be starting with part A. So you can answer this in any order. They are not linked, the 3 issues. Okay, let us start with the first one. Before that, there are first few lines which we need to read, which gives you the background of the question. Stent is a consumer electronic company which has faced a challenging year due to increased competition. Challenging year. Okay, due to increased competition. Stent has a year-end of 30th September 2009 and the unaudited draft financial statements report an operating loss. There's an operating loss in the unaudited financial statements. In addition to this, debt covenant limits based on gearing are close to being breached. Okay, you see, gearing are close to being breached. That's why they told the impact upon gearing of the 3 issues. And the company is approaching its overdraft limit. And the company is approaching its overdraft limit. That shows that company is not in a good liquid condition. Okay. So now we'll read it. On 27th September 2009, just 3 days before the year end, if you see, Stent finance director asked the accountant to record a cash advance of 3 million received from a customer. Buster as a reduction in trade receivable. Okay, cash advance 3 million received as a reduction in trade receivable to record it. Buster is solely owned by Stent's finance director. Okay, who is Buster? Customer, but this customer is owned by Stent's company's finance director. The accountant, that company, the accountant has seen an agreement signed by both companies stating that the 3 million will be repaid to Buster in 4 months time. Okay, they have a contract that this will be repaid to Buster in 4 months time. The 3 million. The finance director argues that the proposed accounting treatment is acceptable. They are saying that this accounting treatment is acceptable because the payment has been made in advance in case Buster wishes to order goods in the next 4 months. However, the accountant has seen no evidence of any intent from Buster to place orders with Stent. Okay, there is no evidence that Buster will place an order with Stent company. Now, based on this information, you have to give right. Remember, whenever a question like this comes, where you have to give an accounting reporting issues, first place you have to look for is the standard. Which standard is applicable for that? For this, which standard is applicable? Before I actually go through the answer, I want to pose this question to you. Keep answer ready and see whether it matches or not. If your answer matches with the answer which I'm going to give you, that means good thing that you have understood. If you're not, don't worry, don't be sad. There is still time before the exam. You have enough time to practice. Go back and study your standards. This is why SBR becomes a little complicated because it's not straightforward. By reading this paragraph, nothing is mentioned about any standard, so it's hard to find out a standard. But there are such certain words are there. For example, you have received cash. Okay, it is shown as a reduction in trade receivable. And also, you can see the finance director of Stent is he is the owner of the company and who is also the customer. Buster is also the customer, but that company is owned by the Stent company's finance director. So there are so many issues for that with it. It looks like that there is an issue with IS 24 relating party. Now we'll see the answer. Your discussion of the re-accounting issues can only score 11. Make sure that you manage your time carefully. Your answer should be much briefer than the model answer below. Don't forget to comment on the gearing impact. Gearing impact has to be there. 3 marks. Okay, easy marks can be obtained for anything for discussing action that accountants in the scenario should take. So, when you answer these questions, make sure that you write the proper subheading for each issue. First one is cash advance. Okay, as I told, right? I have guessed it right. It's IS 24, right? How do I know it's IS 24? Related party issue? Because you can see a finance director is like a key management personnel. He's the key person, key employee in a company, but he is the one who is owning the customer company, Buster. So that statement, this statement tells me it's IS 24. You see, because there is no separate standard just dealing with cash rather than IS 7, but this is not IS 7 cash flow statement. Okay, this is about cash advance. So that's why standard is IS. Usually for accounting issues is usually one standard. Okay, it's not, most standards are not asked because it's just for 4 marks. In 4 marks they cannot ask you to combination of 2 3 standard. Okay, that is done in group accounting, but in this question it is only IS 24. IS 24 deals with related party disclosure. So first paragraph, you need to talk, you need to divide your answer in paragraphs. Now since it's for 4 marks, you can even write in 4 different paragraphs. First one maybe the definition of IS 24. Second, you are linking it to the case study. Third and fourth, maybe you are telling the impact on the gearing. Okay, if you see here, okay, this answer is long. It's longer than what is required for 4 marks. So make sure that you don't have to write all these points. But for understanding, we'll just read it. Definitely IS 24 is the standard. This you have to write. Okay. So IS 24 requires an entity's financial statements to contain disclosure necessary to draw attention to the possibility that its financial statements may have been affected by the existence of related parties and by transactions and outstanding balances with such parties. That means you need to disclose if there are any related parties between you and all. Okay, IS 24 says that. Second, finance director of Stent is a related party to Stent. This line you need to write. So from IS 24 we can say that finance director of Stent is a related party of Stent company. The finance director controls Buster. Okay, now you need to know what you need to say how they are related party, because finance director, he controls Buster. Buster is also a customer, right? And therefore Stent and Buster are related parties of each other. Because finance director of Stent controls Buster, in that case Stent and Buster became related parties of one another. You need to write it. So as such, Stent must disclose nature of related party transaction. What should you do? You should write this also. That because related parties there is what Stent should do. Stent should disclose the nature of that related party relationship with Buster as well as information about all transactions and outstanding balances between Stent and Buster. Whatever the transaction happens between these two, Stent and Buster needs to be disclosed. Okay, with the balance, outstanding balance, and also the nature of related party transaction. Two things needs to be disclosed. One is the nature of related party relationship. The other one is transactions and outstanding balances. Okay, according to IS 24, if you're having a not understanding what needs to be disclosed, clearly it's there under IS 24 what needs to be disclosed. Okay, you can go and check IS 24, the standard, and see what are the two things that is disclosed. So till here you were using the knowledge of IS 24. Now you are linking it to the case study. So according to conceptual, now you can use the conceptual framework also. It's not always standard. Sometimes you can even use conceptual frameworks definitions also. What does conceptual framework says on advance payment? It's like a liability on you. You have taken a cash advance payment in cash. That's why you are using conceptual framework because it is advancement of cash. It's like a liability. So definition of liability is given to you in the conceptual framework. That's why you are using conceptual framework. So according to the conceptual framework, the advance from Buster is a liability. That advance is a liability. So Stent has a present obligation. What is present obligation? Legal enforceable as a binding contract. Because of that contract between you both, you are legally enforceable. Legally enforceable. Okay, to pay. It's like a liability. The settlement of which involves Stent giving up resources and bonding economic benefits in order to satisfy the claim. You have to give that amount back. Cash advance. Present obligation is there for Stent to give up resources. That means they have to pay back the liability. Repay the liability. This is exact definitions word by word from conceptual framework. Okay. Now, bar some exemptions, IFRS standards do not permit offsetting. Why they said some exemptions? Because in some IFRS, offsetting is there. One of it is IS 32. Okay, IS 32 says you can offset only if two conditions are satisfied. We'll go to that later. First, we'll see how did we go till there. So, except when it reflects the substance of the transaction of other event, we have to talk about offsetting because cash payment we have done it, we reduced it from receivable. Rather than showing the cash advancement as a separate and receivable as a separate, what we did, we deduct it from receivable. So we offset our asset with the liability. That's what we did. But IFRS standard says it's not permitted. Except when it reflects the substance of the transaction or the event. Offsetting detracts from the ability of users to understand the entity's transactions and to assess the entity's future cash flows. Why offsetting is not allowed? Because it does not allow the user to understand what's happening. What is with the cash flow and the transactions? IS1, another standard. What does IS1 says? IS1 talks about presentation of financial statements, how you need to present the assets and liabilities. That's why you're talking about IS1 also in your answer. But very briefly, not in detail. So IS1 states that an entity shall not offset. They told that you should not offset assets and liabilities. IS1 says assets should be shown separately, liability should be shown separately. We don't minus the liabilities from assets and then show the net assets only, right? Unless required or permitted by an IFRS standard. Sometimes IFRS standard, if it requires, then you can offset, otherwise no. One exception is IS 32. Offsetting where we offset a financial asset with a financial liability. It is permitted according to IS 32. Okay. Presentation when and only when an entity has a legal enforceable right to set. Two conditions are satisfied. What are those two conditions? When an entity has a legally enforceable right to set off recognized amounts and intends either to sell on a net basis or to realize net asset at this one. Number one, they have the legal enforceable right to set off. Number two, either they intend to sell on a net basis or the realization of the asset and settlement of the liability are together. In the simultaneously they are done. That time you can net it off. Okay, see all those things relating to IS-32 you don't have to write in your answer, it's not needed. Okay, this is additional. They're just explaining you how it is presented in IS-32. For your answer, it's not needed. No such agreement is evident in this case because you will not have time. If you have time, you can beautifully write all these things. But definitely you will not have that time to write all this. That's why they always tell don't follow the model answer. They are given in more detail. So no such agreement is evident in this case. Right? What case? Neither you are legally enforceable right to do so, neither you intend to settle on net basis, neither you realize the asset and settle the liability simultaneously. You don't do that, so you cannot net it off. Okay, you see how they are using the information of IS-32 as a justification to not net it off. This is the way of building your answers for any SBR answer. This is just, I'm showing you a demo on how to, rather than you just saying that it cannot be netted off, it should never be netted off, you are giving information from other standards. You are taking the help of IS-1 and IS-32 to say that because this is not the case, you should not net it off. Okay, so no such agreement is evident in this case. So Stent should report the receivable and advance separately. The cash advance and the receivable separately you should show. Second conclusion you are giving. Don't forget to show the impact of gearing. See, 3 marks you will get and 1 mark to show the impact on gearing. 3 marks how? You use IS-32, 1 mark for that. You used IS-1, another mark for that. You use IS-24, another mark for that. IS-24, IS-24, IS-1, IS-32. So 1 mark for each. And finally, impact on gearing. You understanding? Or maybe conceptual framework. So if you're using conceptual framework, one of the standard you can eliminate IS-32 because here IS-1, IS-32, conceptual framework, IS-24, 4 things, and with the gearing 5. So one you can eliminate because the question is for 4 marks. Okay. Now let us go to the impact of gearing. It's in the last paragraph. If error was not corrected, Stent should be showing would be lowering and lower current asset figure and concealing the liability. If the error was not corrected, what would be the impact? Lower current asset, it will be showing a lower current asset and liability will be concealed. How? Because that liability you are deducting from asset and showing, so liability amount will go down. Okay, definitely current asset figure will go down because receivable comes under current asset. So that cash advance when you are deducting from receivable, so receivable amount will go down, that means current asset will go down, liability will be concealed. You don't know what is the figure for liability because it is already deducted from the receivable and shown as a net current. So liability will be concerned, current asset will go down if disclosed as a, so you have to show the impact of both. If you show, if you correct the mistake, if you don't correct the mistake, that's what they have done if the error was not corrected. But if it is disclosed, what happens? Current liability, it might be included, so the current liability will be included in the debt element of the gearing calculation, thus increasing gearing. This is what you should show. This is known as impact. When they ask you what is the impact of gearing, this is the way you write. Rather than just writing increase or decrease gearing, you write, if you disclose it, then it comes as a current liability. Current liability, you take it in the debt element of the gearing debt element of the gearing calculation. Remember the formula for gearing calculation: debt divided by debt plus equity. Okay, that's why that debt comes there. So gearing will increase. If debt increases means now you are including that as a current liability. That means a debt. So debt increases means gearing will increase. Now we are going to the second issue. Also same way we have to answer. How we have to answer the previous one. 4 points at least we need to write to get 4 points. 4 marks. Because this is also 4 points. It is convertible, redeemable preference share. But we didn't read this thing, so we'll read it. On 1st October 2008, CEO of Finance Director each paid 2 million cash in exchange for preference share from Stent, which provide cumulative dividends of 7% per annum. 7% cash in exchange for preference share, 7%. This preference share can either be converted into a fixed number of ordinary shares in 2 years' time or redeemed at par on the same date at the choice of the holder. Who has the choice? Holder has the choice. You can change it either to the ordinary share or you redeem it at par on the same date. The finance director suggests to the accountant that the preference share should be classified as equity. What did they say? Remember, preference share can either be shown as an equity or a liability. But there it depends whether it is redeemable or irredeemable. Okay? Because the conversion into a fixed number of ordinary share on a fixed date, fixed for fix, and conversion is certain. That means they are very sure that they are going to convert this preference to equity. That's why they think that accountant should classify this as equity, given that the current market value of the ordinary shares. Okay, so we'll see which standard should we use before I actually go to the answer. See, just because you see the word share, don't take IFRS 2, which is what is share? That is share based payment. Share based payment is something else, and converting preference into share is another thing. Okay, share based payment is when you give your employee share options or remuneration or in terms of shares. No, you're not giving cash, like you're not giving salary in terms of cash only. You're giving other ways to motivate your employees, remuneration and all. It's like a cost to the company. Okay, through share options, executive share option plans, right? So that is dealt under IFRS 2, share based payment. So what is the standard? Where you convert and then you can classify. IFRS 9. If you have guessed it IFRS 9, then you are very right. It is IFRS 9. Okay. It's not IFRS 9, it's IS 32. IS 32 is also part of financial instruments only, but IS 32 defines equity with liability. So if anything comes where you have the classification of equity versus liability, it is dealt under IS 32, not IFRS 9. I'm sorry for that mistake. What does the tutorial note says? Memorize the definition of financial assets, financial liabilities, equity. Classification of financial instruments is a popular exam topic. I have already covered financial liabilities and financial assets. The video, you can check it out. And also the classification of financial instruments. IS 32, IFRS 7. These two standards has been covered. The videos are already out. So you start by defining IS 32. How does it define equity versus how does it define liability? So your starting point is this. IS 32 defines an equity instrument. What is it? It is like after you deduct your liabilities from your assets. It's like a residual interest. Residual means whatever is remaining. Okay. After you deduct liabilities from assets, that is known as equity instrument. An entity, an equity instrument has no contractual obligation. Financial liability has contractual obligation. Equity instrument has no contractual obligation to deliver cash or another financial asset or to exchange financial asset or financial liability under potentially unfavorable conditions. Remember the word unfavorable. Whether it is financial liability or equity, conditions are unfavorable. Reason I'm telling you to memorize it because when it comes to financial asset, it is favorable conditions. Same definition, but unfavorable changes into favorable conditions. Okay, but for equity and financial liability, conditions are unfavorable. Because definitely you want to exchange financial liability when conditions are not good, when conditions are unfavorable, right? But financial asset, when it's favorable, you want to take that financial asset. You want to receive that financial asset, cash or another financial asset. Here also it's deliver. The word is deliver. When it's financial asset, it's receive. When is financial liability or equity? It is deliver. Okay. The definition for financial liability and equity are same except no contractual obligation. That's it. Everything else is same. Now, if settled by the issue, so basically you have to tell the difference between equity and liability. That's what the question is asking, the standard. So if settled by the issuer's own equity instruments, an equity instrument has no contractual obligation to deliver a variable number of shares. Okay. Then what happens? What is the critical feature in differentiating a financial liability from an equity instrument? It is the existence of contractual obligation. Whether this is exist or not. If it is existed, financial liability. If it is not existed, equity instrument. Financial obligation of the issuer either to deliver cash or another financial asset to the holder or to exchange. So you can deliver cash or you can either deliver cash or financial asset. Okay. Sometimes you just don't deliver. It's like you exchange financial asset or financial liabilities with the holder under conditions which are unfavorable. As I told, equity is unfavorable. So now you are linking this to the preference share. Under that, what should you do with the preference share? Okay. Preference share offer the holder the choice. Who has the choice? The holder has the choice of conversion. Either they can convert, either they can redeem. So they can convert into ordinary shares as well as redemption in 2 years' time. Stent should separately recognize a financial liability. What should they do? Separately recognize a financial liability. What is financial liability? It has a contractual arrangement to deliver cash on other financial asset and equity instrument and an equity instrument. What is equity instrument? A call option granting the holder the right for a specific period of time to convert into a fixed number of ordinary shares of the entity. You show it as a financial liability. Okay? Because holder has the choice of conversion. Please read the tutorial note also. Don't just tell the examiner that the instrument should be split into liability and equity components. Explain how these components are measured. If it is equity, how it is measured. If it is liability, how it is measured. Stent would measure the fair value of consideration in respect of the liability. What do you measure? Fair value of consideration in respect of liability. Based on the fair value of similar liability without any associated equity. Conversion option. That's what we do, right? That, see, they will always give you some percentage. Remember that this is the percentage that if there is a similar liability, but they don't have conversion option to that older liability similar to what you have, they will give you some percentage. That percentage only used to your discount factor. So same thing, there you are doing calculations, here you're writing in words. Okay, that fair value of liability, if you want to get, you see the similar liability. What is the fair value of similar liability but without any associated equity conversion option to attach to that? The equity component is assigned the residual amount. That means the balance is equity component. First you always start with the liability component, you find out, then balance is equity component. This you need to write. This part has to be there in your answer. If it's not there, you will not get full marks. Remember to comment on gearing. For this also, gearing is there. What will happen to the gearing? You told is financial liability, so gearing will increase. It will increase gearing. Financial liability. Okay. So correction of this error. If you correct the error, it will increase the non-current debt. Because your liability, financial liability will increase. Financial liabilities are non-current debt. It's presented under non-current debt. You should know this. So it will increase, gearing will increase. Okay, and equity will decrease because you are not showing it as in equity. It is currently shown in equity, but it needs to be removed from equity in the financial liability. So equity will go down, liability will go up. Okay. In the bracket, if you see, they have given the definition also, the present value of the future obligations. Now the third, deferred tax asset, 3 marks. Stent includes a deferred tax asset in his statement of financial position based on losses incurred in the current and the previous 2 years. The finance director is asked about the accountant. He included deferred tax based on losses. The finance director asked the accountant to include the deferred tax asset in full. He has suggested this on the basis that Stern would return to profitability once his funding issues are resolved. So he thinks that he will return to profitability once its funding issues are resolved. That's why he's saying that that's why they need to recognize deferred tax asset in full. Is it justifiable? Which standard you have to use? The moment you see deferred tax asset, it is IS 12. Accounting treatment means according to standards, how do you treat it? Okay. This is also a common exam topic. Recognition of deferred tax asset in respect of unused tax losses. So you memorize the principle below. For 3 marks, this is a big answer. Okay. So let us read IS 12. So in accordance with IS 12, how do you recognize deferred tax? It should be recognized the carry forward of unused tax losses. To the extent that it is probable that future taxable profit will be available against which unused tax losses can be utilized. You cannot recognize full deferred tax, only up to the amount of the future taxable profit. If, let's say for example, if you have uh, losses of 5,000 but you are having a profit of 2,000 in the future, so only up to 2,000 you can take as deferred tax, 2,000 into the percentage of tax, not more than that, not the whole 5,000 you cannot take. Okay. Second paragraph. However, the existence of unused tax losses is strong evidence that future taxable profit may not be available. Okay, so make sure that you write these sentences. Since in the past, we know that if it's in the past with losses, then it's hard to say that in the future there suddenly there will be a profit, right? So it's a strong evidence that in future also there might not be a profit available. Therefore, when an entity has a history of recent losses, entity recognizes a deferred tax asset arising from unused tax losses only to the extent that it has a convincing evidence that sufficient taxable profit will be available against which unused tax losses can be utilized. Evidence should be there. Strong evidence has to be there when you're recognizing deferred tax. Only up to that amount. If you have the evidence, you recognize deferred tax asset. Otherwise, don't recognize. In such circumstances, amount of deferred tax and nature of evidence supporting its recognition must be disclosed. What should be disclosed? What is the amount of deferred tax asset and the nature of evidence that suppose that the recognition must be disclosed. It should be disclosed, okay? When you are recognizing deferred tax asset, the nature of evidence and also the amount of deferred tax. Third, finally, we are linking it to the company, what the company will be doing now. The directors should consider whether it is probable. So the director should actually see whether it is probable that they will be making taxable profit in the future or not. Okay. Before the unused tax losses or unused tax credit expires, remember there's a time limit for that. It's not that unlimited time you can carry forward the tax losses. There is a time after that it will expire. After that, even if you make taxable profit, you cannot carry forward those unused tax losses. Okay. So whether the unused tax losses result from identifiable causes which are unlikely to recur. You have to consider these things. Okay, few things you need to consider. What are those things? Unused tax losses. Whether it results from some identifiable cause. Do you know the cause? How the tax losses came? Can you identify? Right? But it's unlikely to recur. Right? The causes are not the same and it will not recur in the future. In the future, the condition might be something else. So it's kind of hard to identify. Next, whether tax planning opportunities are available to the entity which will create taxable profit in the period in which unused tax losses can be utilized. Next is tax planning. Tax planning means you have to see if you carry forward the tax loss in the future, your tax will go down, right? But if already the amount, let's say you are not carrying forward, you have to think of your personal allowance and all those things. If you can utilize it. Okay, if you carry forward your tax loss and your amount becomes so small that you are not utilizing the full personal allowance is lost, that you cannot carry forward. Okay, personal allowance in tax. But so you have to you have to see whether fully can you utilize against the profit the tax losses or only few, because personal allowance you cannot carry forward, it will be lost if you are not utilizing in the current year after you have taken the losses, but definitely losses you can take it forward. So you have to plan, it's called tax planning. You have to see the way you plan. Ultimate goal is to minimize the tax. Okay, you should minimize the tax whichever is giving the lowest tax, whether taking forward their losses, or if it falls less than the personal allowance, then it will be automatically it will be zero, so your tax is nil. That means you cannot carry forward the loss. Okay. To the extent that it is not probable the tax of profit will be available against unused tax losses, unused tax credits can be utilized, the deferred taxes should be not recognized. If okay, to the amount that there are no taxable profit for it, that you can recognize unused tax losses, deferred tax assets should not be recognized. I've given the example of 2000 and 5000. Tax loss is 5000. You have profit of 2000 in the next year. Only 2000 you can recognize. The balance 3000 deferred tax asset you should not recognize. And remember, mind you, under IS 12, rules relating to deferred tax asset are more stricter compared to deferred tax liability. Okay. Don't forget gearing. They don't impact of gearing on all the three issues. So if you remove the deferred tax asset, what happens? Because they told it should not be recognized the full credit, so you're removing part of some of it, right? So when you remove it, it's an asset, it will reduce net asset. Net asset reduce means equity and gearing will increase. Equity also will increase, gearing also will increase. Okay. Sorry, net asset and equity will reduce. Okay, so if equity reduces, gearing will increase. Okay, because the net asset is from equity, it will reduce your equity. If equity, we know in the gearing formula, debt and equity both come. So if equity falls down, gearing will go up. Okay. So now we have completely finished all the three accounting issues. Now comes the ethical aspect. Okay. Ethical aspect. One question, if you're able to do it, all the other questions you'll be able to do it. That's a good thing about ethics, because the answers are similar. You're using the ACCS 5 Professional Code of Ethics, how it has been how it is threatened, and how to overcome it. That's it in ethics. But before it, let us read. But I always suggest that ethical questions should be done at the end. Okay, because there are some things you might need from part A to answer part B, ethical issues. Okay. The accountant has been in a position for a few months, and the finance director has recently commented that all these accounting treatments must be made exactly as I've suggested to ensure the growth of the business and security of all our jobs. Both finance director and accountant are ACCA qualified. Both are ACCA qualified. Number one. So they are bounded by some ethical rules. Okay. And also you have to see that she is in her position only for a few months. This is again a new kind of threat. And finance director says he's like the one who's threatening, he's like the boss. That all accounting statements should be done according to the way he says, whether it's correct, whether it's not, according to the standard. Because this helps for the business to grow and the security of all our jobs. So he's only worried about the security of his jobs. That's it. So with this, you need the support of all these accounting issues to answer your ethical issue. It is always like that. Ethical question is like that. Seven marks. Do not attempt the ethics requirement first. If you work through and understand the accounting errors made, then you will have more specific comments to make about ethics in part B. You see, yes, you can do ethical question, but it's better to do it at the end. Why? Because some of the accounting issues or errors in part A, exactly you can use in part B also. You can use it in part B and be more specific and get more points. This will improve the quality of your answer and so make it more likely that you will receive the professional marks. If you improve the quality of your answer, automatically you will increase your professional marks, the 2 marks. Just will go have a look how the answer is, right? You need to write ethical aspect as a subheading and then you start explaining. Okay, there are so many things you can explain. 7 marks, at least 3 4 points you can explain. 3 4 points you will get, or let's say 5 marks you will get for explaining just the ethical issues, or 2 or 3 marks you will get for recommendations for the actions that you suggest. Okay, so this is how you need to divide your marks when you are writing. Now let us read. This question can be attempted in any way, okay, that you want. Need not be exactly what is written, but just as a benchmark you can keep this answer and then compare your answer with it. What other points are you writing and all. Let us start. So they have started by saying ACCA rule book. What does the ACCA rule book says? It contains the bylaws. All these things, if you can eliminate. Okay, if you don't want, don't write it. It's okay. It's fine. But what's important is at least the 5 code of ethics you should remember: professional competence and due care, professional behavior, integrity, objectivity, and confidentiality. These 5 things you need to remember. Okay, and out of this 5, what is being threatened and how to overcome it. But since they are members of ACCA, you can say because they are members of ACCA, so they are bound by the code of ethics of the ACCA. So this also you can write it like this also. Now let us read the answer. The ACCA rulebook contains bylaws, regulations, code of ethics. If you just say code of ethics is enough, and conduct which every ACCA member should follow. We all know, right, that every ACCA member has some code of ethics to follow. The accountant may feel. Okay, so it's better to start this way. Ethical questions that because they are ACCA members, so they have code of ethics, so follow that. You start with this. Then you proceed by saying that how accountant may feel pressurized or what. Okay, so accountant may feel pressured by the finance director's comments on job security given that the accountant had already been in a position for few months. You are giving the conditions or the scenario why they are being pressurized or how they can be pressurized. Okay, that is your second line. So they may feel pressured by whom? Who is feeling pressurized by whom? Accountant is feeling pressurized by finance director's comment, right? Remember he made a comment on job security that if you do as what I say, your job is secure. Okay, and also this increases this pressure is increased more because the accountant is in her position for few months already. We all know that when we are new to an organization, whatever our senior people say, we must listen to it because we can lose our jobs. We are more worried about the survival of our job than we can think of anything else. So we anyway how want to keep that position when we are new into that position, right? So we are more threatened. We will feel more pressurized to follow what our senior have told us to do. Exactly this condition you need to. You are presenting this condition in your own words. You are writing what's actually happening. Even in your exam, you need to write this. Who is feeling pressurized by whom? And how is he feeling pressurized? Because of the finance director's comments made on the job security. He told you do as I say, your job is secure. So all these facts from the case study needs to be there in your answer. Before you actually give ethical issues that professional competence is not there, he's not following professional behavior, he's not taking due care. Before actually saying this, you need to set out the this thing for the case study. Next, after this, once you set it up, now you say accountant should comply with the fundamental ethical principles set out in the ACC. Who should? Accountant, because the ACCA member. Both are ACCA member. In fact, it's given finance director as well as accountant. So now accountant should comply with the fundamental ethical principles set out in ACC rulebook. What is it? You can list down if you want. Integrity, objectivity, professional competence and due care, confidentiality, professional behavior. The accountant should be mindful of any threat to this fundamental ethical principle. They should be mindful of any thread. So if there are any thread, accountant should be careful of those thread to this 5 fundamental ethical principles. Memorize this answer. It will help you whenever an ethical question pops up. Okay. In doing so, the accountant should consider the relevant facts. What is it? The ethical issues involved. You should see the ethical issues involved. The fundamental principles which are threatened. Why the internal procedure exists, which, okay. So when the fundamental principles are threatened, you have to see these things. Whether there are some internal procedures which are there in the company, which can mitigate the threats, or alternative courses of action should be taken. Next, now you go on to comment. You have set the base in the first paragraph. Now second paragraph, you start by saying, comment on the ethical principles that are threatened in the scenario and explain why this is the case. How the ethical principles are threatened in the scenario. You have 3 scenarios. In all the 3, some or the other way, something has been threatened. So from there itself, you will get 3 marks. 1 mark for each scenario. Understanding? So if you see, think carefully, don't read the answer. What are the fundamental, out of the 5 fundamental ethical principles, what is being threatened? Is your confidentiality being threatened? No, nothing has been mentioned about confidentiality and all. Professional behavior? Yes. Professional competence and due care? Yes. Integrity? Yes. Objectivity? Yes. All the other 4 has been threatened. In this case, all fundamental ethical principles, with the exception of confidentiality, appear under threat. All are under threat. Sometimes this is the only difference in your answer, from answer to answer. You have to see which fundamental ethical principles are threatened. Sometimes it might be out of 5, maybe only 3. Sometimes only 2. Sometimes only 1. Sometimes all 5 of them. Sometimes, like in this case, just 4 out of 5. Okay. Definitely it's more than 1, 2 or 3 or 4. Or sometimes all 5. Okay. That you have to see. This varies from case to case. From question to question. This things only varies. Which one is threatened? So the finance director appears to be following bias and undue influence from pressure imposed by debt covenant gearing and overdraft limit. You are exactly saying what is in the case study. What is in the case study? They have told that they are near to breaching their in the beginning. Remember, in the beginning, in the introduction paragraph, they told that they are near to breaching their debt covenant, and also they are approaching their overdraft limit. That's why there's 2 things they have mentioned in your answer. So whenever they have mentioned something specifically in your case study, bring it out in your answer. This will give you marks. Overdraft limit and debt covenant gearing. Why is finance director doing it so? You have to say, not see, explain why is the case. It's not enough to say ethical principles are threatened, but why are they are threatened? That also you have to say, because finance director, they are imposed. Okay, they have to follow the debt covenant gearing and overdraft limit. That's why they are doing all those things. They don't want to do it. No one wants to do a crime. No one wants to do a fraud or anything. They must have. They are being induced by something. Some event must have happened which is out of their control. Right? They want to keep that debt covenant gearing below a certain limit so that they get loans. They can increase their borrowing. Overdraft limit, so they can take the overdraft. That's why they are not recognized. If, for example, if they have to recognize such a certain item as a liability, they're not recognizing it. Instead, they're recognizing it as an equity. Why? Because they want to show low gearing, hence low liability, hence low gearing, which shows that they are in a good position. So the bank will give them loan also based on their gearing position and all. You see. So this is actually what's happening, which you need to put in your own words. The finance director appears to be allowing bias and undue influence from the pressure imposed by. Finance director, he himself is imposed by some pressure. That's why he's putting pressure on the accountant. So this is the scenario which you need to say. This is the case actually. Every case, some scenario is there. So that scenario you have to put it. You have to write it in your answer. Okay. That's why he's being biased towards lowering gearing and all. And also undue influence. Also, there's an influence, also pressure from them. Okay. Into the choice of accounting treatment. That's why they're choosing the accounting treatment, what they're choosing. Rather than following accounting standards. So the company is in a precarious position, reporting losses in the year. Now you have to mention about the company. See, whenever some ethical issues comes, it mostly comes when your company is not doing good. Maybe some losses are there. Okay, somehow you want to get some loan or want to expand something, then you do all these unethical issues, because if you go through ethical way, you will not be able to do it. If you honestly go and say, okay, I'm making losses, okay, I am having this liability, my covenant is I'm breaking the debt covenant. So if you're being honest, do you think the bank will give you the loan in the future? It will bring a bad reputation to your company that you are not financially solvent, that you are making losses, your gearing is high, you have finished your word of limit. So that's why you have to see the issue in the company, in the case study, because from there only unethical issues comes. That is the root cause that the company is in reporting losses in the year. Definitely, if the company is reporting losses, that's why they are going for the overdraft limit, debt covenant is breaching, because they want to take debt to run the company. If the company is doing well, no one takes debt to run the company. No one takes overdraft limit to run the company. You understanding? So they are reporting losses in the year. So this also you have to write in your answer. What is the position of the company? Mostly, if ethical question is there, if you will see one common theme is there, company is operating in losses. Okay. So the finance director should add professional. These are the actions you are telling. Okay. They should they should act professionally in accordance with applicable technical and professional standards. One is technical, one is professional standard. Technical standards, for example, use the standards IFRS, IAS. Professional standards, be professional. You are an ACCA member. You have some standard. Okay, people expect highly from you. So that is known as professional standards. Applicable standard or standard or technical standard is your standards IFRS, IAS, and all. Comply with relevant laws and regulations. Okay, the finance director, they should professionally act with the standard. They should comply with the rules and regulations also, and avoid any actions which discredits the profession. This is for the finance director you are saying. Now you are going to the accountant, because actually accountant is the one who is facing all the threat, whether it's objectivity threat, whether it is professional behavior threat and all. So now we are moving towards the accountant. Next paragraph, write it in different paragraphs. Accountant faces an intimidation threat. There are 5 types of threat. This you need to write in your ethical questions. Okay, other than the 5 code of ethics, what are the 5 types of threat? Intimidation threat, familiarity threat, then what else is there? Self-interest threat, self-review threat, advocacy threat. These are the 5 types of threat. Memorize it. Here it's intimidation threat. Intimidation threat means when you are pressurized to do something. Okay, pressure faces an intimidation threat to objectivity given the comments from the finance director. How are you facing the intimidation threat? You have to say that also. It's not enough to say he's facing intimidation threat, he's facing self-review threat, he's facing self-interest threat, blah 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 blah. But why is he facing intimidation threat? How? By the comments given from the finance director. He told that do as I say, otherwise you're out of the job. That is intimidation threat. You're intimidating someone who presumably has an influence over career prospects. So who has the career influence? Your finance director. He has an influence over you. Assuming that the accountant wishes to keep a job. Okay, so now let's see, most 99% you will see Accountant wants to keep her job. No one wants to throw her job. So you cannot say, okay, resign. Most of the students at this stage, they start saying, okay, he must resign. He must not be unethical. He must be ethical. Don't don't ever say he must be ethical in the ethical question. Okay, I know it's this thing contradictory that you should be ethical, but at the same time, don't write he should be ethical in your answer. Okay. So assuming that the accountant vision more 99% accountant wants to keep her job initially when he's hired, right? So if he wants to keep her job, there are some additional thread which will come up. What is it? Intimidation threat gives rise to self-interest threat to objectivity. Self-interest threat to objectivity. Self-interest thread is there. What is the self-interest thread? Self-interest because he wants to, he has his own interest. What is his interest? His interest is job. He's getting a salary. He's, as far as he's getting his job, he's getting a salary. It is a self-interest thread because if he do what the finance director has told him to do, he will have his job, he will get his payment. That is a self-interest thread. He has an interest over there. His self-interest. His self-interest is his job and money. To objectivity. Objectivity thread is also there. He will not be objective anymore. Whatever decision, whatever accounting treatment he does will be biased towards the interest of the finance director. Okay. Objective means you have to be independent. You cannot be influenced by anyone's interest. Independently, you have to give the decision, whatever the treatment you do. But he is not being objective. So objectivity thread is there, self-interest thread is there. Okay. Now next comes action. Finally comes the action. Your last paragraph should always be actions. What should the accountant do now? And most of your technical, sorry, most the professional marks you will get in this part. The actions that you suggest. Here, this is an area where you are going to get the 2 professional marks. What are the actions that you suggest? Because these actions you need to think from your side, out of the box. You have to think. Definitely, it should be something which is applicable and which can be applied in reality. It should be practical enough that can be applied by this company. But also look at the tone they are writing the answer. It's like you are persuading. You are like persuading someone that don't do this, do this. This is not good, this is bad. You should do this rather. For that tone you are applying, you are getting professional marks. Before I actually go through this action, what accountants should do, let me take you through the marking scheme. Okay, let's see. Resignation is often the last resort. Don't start by saying because accountant is threatened, so he must resign. So here, application of the following discussion to the scenario. Okay, so 443, ethical principles 2, application that to the scenario and recommended action together is 5 marks. And professional marks is 2. So professional marks is number 1 is in the tone that you are using. Now the same thing you can write in another way, a little ruder way. Okay, you can say, oh, this finance director is bad, he is being unethical, what he's doing is not fair, he knows he's a ACCM member, he should not do this, he should be what to say, he should resign from his post as a finance director, he should not be kept as all this route. There are students who actually do that. That's why I'm telling you not to do it. You should not be rude if you use such comments. This is the way if you write. First of all, you should not write it. You are not. Second thing, you will lose your professional marks. You will not get the professional marks. One of the professional mark is on the tone that you use. And number 2 is the flow of your answer. You started by saying that he is an ACCM member, therefore these are the rules he should follow. If there's any thread, he should be careful of it. Next, you went on to say that these are the threats. Then you went on to explain the scenario that finance directors under this condition. That's why he's threatening the accountant. He himself is threatened by the rules imposed on him, debt covenant and bank overdraft limit. Therefore, he's threatening accountant. So there's a flow of an answer if you see. From how he went to the ethical issues, then after ethical issues, he went on to explain the actions. So if you follow this order, one professional mark, the other one is your tone that you are using. You should not use rude comments. Okay. So if you go through all the ethical issues, you will see that same tone they use, same way they answer. That's why ethical question is one of the easiest question to answer and to get marks. So now let us finish this part also. The action part. Before acting, accountant should speak. You see, this is the tone they are using. The way you are giving the actions, one after the other. It should be in that order only. You cannot say he should resign. Then you cannot say, okay, he should speak to the finance director. You see, you are changing the order of the action. You are saying accountant should resign, comma, accountant should ask the finance director. Second point you are giving, accountant should speak to finance director. No order is there. Rather, resignation, if you are telling also that he should resign, the accountant, that should be given as the last point. You are getting professional marks here only. How you are ordering and how you are structuring your answer and writing it. So before acting, the accountant should speak with the finance director. Definitely. Most of the ethical question, any ethical question, write this as your first point. That he should first speak with the person who is threatening him. Try to confirm the fact and discuss the treatment with the finance director. Don't go and say he should sue the finance director. Okay? The accountant should sue the finance director for threatening him. Or he should go and take revenge from finance director. Or he should go and say that I'm going to impose you. You wait and watch. No such things has to be written, okay? You should be professional when you're writing answers like this. And don't write he or she. Avoid writing he or she. Write accountant, finance director, because it should be understood who is under ethical issue, who has to take action. That's why everywhere if you see they're writing the accountant, the finance director, the accountant, the finance director. Don't avoid he and she. Don't write he or she. It's not because we it's confusing whether that he is the finance director or the accountant. Okay. Discuss the treatment with the finance and explain it. First, you confirm the fact whether it's true or not. Then you discuss the treatment with the finance director and explain the risk of non-compliance. You see, even in your school also you see if you get late, they immediately don't start sacking you off, right? They will give you first 3 warnings. They will give you after the third warning, then they will take action. So everything has that system. You cannot be very harsh in the beginning. First, you go and try to talk nicely, calmly, kindly, softly with the finance director. You try to explain him that if you don't go by this standard, if you're not complying with the standard, there are risks. You have to pay penalty. Number one, reputational damage is there. Number two, a record of conversions and action should be kept. For writing such points also you will get professional marks. How professionally you are giving the advice. Okay. You have to keep the record of anything because for example, let's assume you finance director have accepted also that he is going to comply later on from the future onwards. But what if later he actually changes his mind? Okay, so you have to keep that evidence that you have actually, from your part being an accountant, you have done your best. You have actually went and spoke with the finance director. You told him that these are the risks, and he actually told okay, he's going to comply. That's why record is need to be kept of what you told, the conversation, also after that what actions the finance director did or you as an accountant did. Then Stent company may also have internal procedure which mitigate the threat. They might have, right? Maybe it's not in the case study, but you can write this. They might have some internal procedure which may mitigate the threat. For example, they might have a section where they can go and complain or whistleblowing. They could go and say, okay, These are the issues going on internally within the company. It may be that the finance director is not technically up to date. Okay, see how he's using. They are using it in a very polite way and a professional way. They are not saying finance director is out of date. Finance director has no knowledge. Therefore, he should not be a finance director in this company. Okay, no, he's not technical up to date. Maybe he's not technically up to date. Don't always say this is not ethical. His intention is to commit fraud. His intention is not good. No, maybe he's not technically up to date. That's why he's not understanding that according to standard this you have to follow. Okay, in which case a safeguard would be to undergo a continuing professional development. So in this condition, if he's not professional up to date, what is your action? What is the safeguard that you have to do? Undergo a continuing professional development. Memorize this answer. Ethical question, you memorize it and give. I usually don't say memorize, but ethical questions memorize. If you memorize one, it's enough. One answer you memorize is enough to apply in the other case study. Here and there, you can change the scenario based on your case study. But these points are same. Undergo professional development, keep record of conversation and actions. These things can be repeated. If the finance director refuses to comply with accounting standards, now you are saying, okay, all this while you are saying go and talk with him. There might be internal procedures. He might be up to date. Then what do you have to do? What if he refuses to comply even after that? Refuses to comply. Okay, these things, everything needs to be written in your answer. First you talk, then you do what? Second, third, fourth, what do you do? And last, if he refuses to comply, then what do you have to do? This also you have to write in your answer. Professional marks, don't forget. So if finance director refuses to comply with the accounting standard, then it will be appropriate to discuss the matter with other directors. Then you have to discuss this matter with whom? Not with the finance director anyway. First is always the finance director, whoever who is threatening you. Next only you go to the other people. Who are they? Directors Audit Committee if applicable to seek a solution. Then seek professional advice from ACCA. This order should be maintained in your answer as well. You go with director or audit committee because they are in the key position, senior position. Only they can have an impact on the finance director. You cannot say go and talk to an employee who is there in the lower level, who cannot have an impact on the finance director. Someone who is above the finance director, you have to go and tell them, right? And consider a legal advice if necessary. Then you go to ACCA for professional advice because you are an ACCA member. So you will get professional advice from them. Then, if necessary, legal advice. See the word they are using. They are not saying you must go to this one. You should go to this one. They are like, consider legal advice if necessary. So use this word as it is. Sometimes you have to take the help of the lawyers and all for such thing. Okay. A final consideration for the accountant is what? Resignation. Final. At the end, you end like this. Ethical answers. Okay. Final consideration. If matters cannot be satisfactorily resolved, if you cannot do it, resolve within you two. After you went to the director and audit committee or took professional advice from ACCA or took legal advice, then also you cannot resolve the matter, then resign. Okay, would be resignation. So all ethical questions follow this framework of this is the structure of ethical answers. Okay, so that's it. Now what else? Go and do other ethical questions and see the similarity. You can see the similarity with the answers. Only the facts of the case study here and there might be different, but it follows the same structure. It ends in the same way. It starts with the same starting, and even the actions also, most of it are similar actions. Okay, so that's it, and do take care and see you in the next video with some exciting questions.